Great ideas don't always breed great opportunities. That is why today we're going to be reviewing how money could be the main driver to a business failing or being successful. We're going to cover the financial statements associated with determining this, and we're also going to look at some of the accounting principles that we're going to use in class to be able to show whether or not we are on track. Chapter 10 covers one of the most interesting subjects in our book, accounting. Norm Brodsky compares a company to a living, breathing person. And just like we have everyday needs, a company has needs in order to be healthy and sustainable. These hiccups or symptoms often show up when we have a disease ourselves, but they could show up in a company when determining and analyzing some of the numbers. Accounting, therefore, is a preventative strategy to help with not knowing what's going on in the company, or you could consider it as a way to find out what's causing something to go wrong. Business owners are not expected to know accounting, but being familiar with it will help tremendously to ensure your accountants are doing right by you. In order to begin, we must discuss three of the most important financial documents a business can have: a balance sheet, an income statement, and a cash flow statement. The book does a great job in describing this through its example of the lemonade stand, which we will go over shortly. So first we have a balance sheet. And a balance sheet is exactly what it states. It's the balance between what the company owns and what the company owes at a given date. Because companies can either earn money or borrow money, the balance sheet is also used to point out the origin of financing for assets and the company uses. For example, the two girls in our textbook who set up a lemonade stand could either borrow money or lemons for their supplies, or being the owners of the business could pay out of their own pocket. Similarly, businesses can borrow through debt or raise their own capital through financing, which requires them to give up some equity or a piece of their business. A key component to debt in business is that it increases both risk and return to investment. If this isn't obvious, consider how the lemonade stand could borrow lemons from their mother. Take, for example, if it costs them $4 to buy a dozen lemons, but their mom has the same amount, they could easily borrow this and use it to make lemonade. If it makes 16 cups at $1 each, assuming they sell all their cups, they would make a revenue of $16. $12 profit, and only $4 would have to go back to mom for letting them borrow the lemons. The girls would not have to put their own money, and therefore they would make $12 in profit using other people's money. Had they not been able to sell all their lemonade, because the girls had a horrible lemonade recipe, for example, they would in turn lose $4 after paying their mom. The risk of losing $4 and the time wasted is worse if they had just bought the lemons themselves. If instead the girl's mother want lemons and not cash, and it turns out that the girls have to buy the lemons, God forbid, because sometimes this does happen, the lemon price might go up. So the risk associated with borrowing becomes even higher. Debt instruments for business don't use lemons, but take into account the time it takes to pay it back through interest. This is the main risk associated with taking out money, as well as the fact that if they don't make the revenue that they project to, they would have to pay it out of pocket. Let's look at the example of the lemon stand one more time. Let's say there are customers who don't have cash on them, and this could be anybody. This could be runners or people who are just, on their way to their house for whatever reason, just out in the park. What's interesting about the example in the story is they allow clients to offer to pay them back in the form of credit. Clients leaving their number and address would come back later in a week to pay these girls. In business, this is known as accounts receivable because they receive income later based on the services they provide. So all these things that we just previously described, debt, cash flow, accounts receivable, are all taken into account on the balance sheet. Finally, the balance comes down from understanding that all things owned by the girls, or rather their assets, should equal their debt and their equity, what they put into the company. This basic concept implies that both the girls' cash and inventory, which includes lemons and lemonade, should equal to how much they put and how much they borrowed. Retained profit is considered an increase in equity as it belongs to the girls. It can present itself as cash on hand or accounts receivable as far as assets are concerned. An income statement refers to the idea that documenting revenue and costs over a period in time can give you insight on your bottom line, how much profit you make. The income statement can have the following format: sales, which really encompasses your revenue or how your money's coming in, minus COGS, which is cost of goods sold, which equals gross profit. Then you would subtract your operating expense or your CapEx, and that will give you your operating profit. Then you would take away interest expense, which is the cost associated with borrowing, and that would give you your profit before taxes, until finally you take out the income tax and you're left with your net profit. In summary, the income statement answers how profitable a business is. Metrics measured are sales, cost of producing and acquiring goods, your operating costs, your interest payments, and then your tax payments. You could use these different numbers to come up with ratios that give you insight that you could benchmark against when it comes to the industry leaders. A cash flow statement is a document that shows sources and uses of cash within a company. This is different from the balance sheet, as one is based on an accrual basis, whereas cash flow is more accurate portrayal of the movement of cash in a business. Accrual just means that profits are documented as they are earned, meaning account receivable can result in profit even when cash isn't received. Cash flow statement, on the other hand, is based on your bank account and where the money is moving to. There are also some metrics that observe liquidity, growth, and debt exposure. These metrics are on page 285 and are an insightful list. The textbook discusses briefly the important documents associated with the matters that the manager should address. Accounting generally applies to information about the transaction and events that make the business run. It is a set of concepts, techniques, and processes used to measure and report information to the planning team. With the financial statements and given information, one would not be surprised to see that innovative accounting follows a similar approach. Eric Ries, as we've introduced him a few times already in the course, stated that the boring stuff, how to measure progress, how to set up milestones, how to prioritize the right ideas, this is what determines and distinguishes the successful businesses from the ones that fail. Innovation accounting is similar in that accounting helps to determine the health of a business by documenting changes in revenue, costs, and profit, whereas innovation accounting allows you to document the changes in processes, procedures, and minimum viable products. Accounting takes into account lagging variables and are the results of business effort. They do not give much insight to the causality of business success. Innovation accounting helps to determine the health and trajectory of business through observing leading variables or variables that would imply success. A good example would be how a grade is a lagging variable, which tells us how well someone did on an exam, whereas studying time is a leading variable, which would also give us an inference, which could also infer student success. So how does one approach developing a system for innovation accounting? First, develop an MVP. Create a hypothesis statement based on your MVP. So it would go something like this. For the customer segment that you are looking to get into, these people want, and then you would state the customer's needs. The MVP, the name of the MVP, the name of the product, is and this is just a one-word description, is a plane, it's a car, it's jewelry, it's tool do you use to smoke, whatever it is, you would put that there. One-word description. That, and then you would state the value proposition. Unlike a competitor in the market, our solution and what differs you. So for example, the microphone I use is a Blue Yeti Snowball, right? So for customers who are recording or attempting to record high quality videos who want a microphone, the Blue Yeti Snowball microphone is a high quality microphone that offers quality sound recording at a low cost. Unlike another competitor, our solution allows people to get involved with recording at a low cost. That's the example of an MVP. Then list the following. What is the business ideal outcome? What do you want to get out of this company? And then what are the leading indicators that would result in that outcome? Second, innovation accounting requires you to have the ability to fine-tune the engine. Based on these discoveries, explore the same ideas and tune it up. Or you would look at the information after doing an experiment or two and quit the search or pivot into a new idea. And finally, there needs to be a way to close pending projects in order to begin new business. So with innovation accounting, the book, The Lean Startup, states that you shouldn't be able to start a new project while one is still pending. So what you want to do is limit either your MVPs or your projects or iterations to maybe a limited amount and not allow the team to go into new or unexplored territory until they finish at least one or two aspects in the bucket, right? And this is just to prevent that there's not a lot of pending things going on. Because again, the key to innovation accounting and the key to the lean startup is validated learning. So if you're just doing a bunch of stuff, sure, you're doing busy work, but if you're not learning, then that's really the big failure. That's the biggest failure as far as the work is concerned.
Close pending projects, what has to be done is we have to focus on the validated learning, and we have to make sure that the learning happens for us with each iteration and with each project. By limiting it to 3 projects or 3 iterations or even 3 design features at a time, we allow ourselves to focus in and hone in on each aspect and learn from each aspect. Also, by doing split testing or cohort testing, we allow ourselves to make sure that we know that this feature or this aspect or this surface is really contributing to the success of the company. What split testing is when you take either 2 separate products or 2 separate designs and test it at the same time. So an example would be is if I wanted to test whether or not my service would do better by registering clients up front and then having them use the service, or showing them the service and then having them register as a result of trying it out and liking it, then I would do 2 separate websites or 2 separate sites where customers would come in doing the first aspect, seeing the service and then registering, and then another website or page where they register first and then see the service. And this way we could see, based on how many people register, we could see which one is most effective and have a validated experience to back up what our findings are. Now, with that being said, we did cover a lot today, but I think it's definitely going to contribute to your guys' success. I do have to apologize for putting up the video late. There was a family emergency that I had to take care of, but I will give you guys more time to do the quiz because of that. If you guys have any questions or any comments, feel free to email me. I look forward to seeing you guys this Tuesday, and we're going to go ahead and go over some of our MVPs and what we discovered. All right, guys, have a great weekend, and take care.